Well, I'm still quite bearish about the US economy. We are close to the end of this very severe recession, but I've been arguing for a while that this is going to be a very anemic, below trend, subpar recovery. And the latest data, the employment report, the consumer confidence, the ISM, durable goods orders are all signaling that actually the recovery is going to be anemic. It's not going to be V-shaped. It's going to be at best U-shaped, and there are even risk of a double dip recession sometime next year. So I see more economic weakness than strength in the data.
But how did that data actually impact your view on the W-shaped recession? Is it more likely to happen now than you were thinking just 2 weeks ago?
Well, in my view, the data suggests that there's going to be a recovery, it's going to be anemic. The risk of a double dip derived from the fact that at some point towards the middle of next year, the fiscal stimulus is going to become a drag, even the monetary stimulus is going to be having less of an effect. And at that point, if there is not a more resilient recovery of private demand, then the lack of the policy stimulus is going to imply risk of a downside to growth. For the time being, at least, the policy stimulus is going to have a net effect that is positive on the economy, but the fundamentals are of a US consumer shopped out, saving less. That burden was to save more, is going to consume less. Of a corporate sector where there is excess capacity utilization only 69%, so there is not going to be capex spending, and of a financial system that essentially is not going to create as much credit as before because it's been damaged. And if you don't have enough credit growth, how are you going to finance residential investment, capex spending, consumer durable spending? So that's going to be also a constraint of growth.
So is there a policy that the Obama administration could put in place to create jobs, or at least stem this jobless rate?
Well, the first thing is probably that both the US and other countries should not exit from this policy stimulus too soon, because the recovery is weak and there are still deflationary pressures, and there is a risk that actually the policy stimulus goes away too soon. The trouble is that we also are facing fiscal problems over the medium term, and the challenge is how you can achieve medium-term fiscal sustainability that requires eventually an increase in taxes and a cut in government spending while maintaining a stimulus in the short run. It's difficult because the US cannot easily politically commit to medium-term fiscal adjustment, and therefore the need for a stimulus in the short run eventually might destabilize market expectation about the sustainability of the current fiscal path.
At what exact point do you believe that these exit strategies need to be implemented?
There is a tension here between the fact that the economy needs a stimulus in the short run and the fact that over the medium term, if you have runaway fiscal deficit and you monetize them, you're going to have a fiscal train wreck, potentially expected inflation rising, and potentially the creation of another asset and credit bubble. And unfortunately, in the short run, we need the monetary and the fiscal stimulus to avoid another tipping point, to avoid deflation. But now this easy money, for example, is already starting to create asset bubbles in equities, in commodities, in credits, in emerging markets. And for the sake of achieving, again, growth, stability, avoiding deflation, we might be planting the seeds of the next cycle of financial instability. That's one of the risks.
You talk about asset bubbles in terms of a correction. Are we going to see it soon? Equities seem to continue rising.
Well, from the lows of March, markets have gone up sharply, equity, credit, commodities. Some of it is justified by expectation of a recovery, less risk aversion, and we avoided the tail risk of a near depression. But in my view, markets have gone up too much, too soon, too fast, in part because now there is this wall of liquidity chasing assets. The real economy is barely recovering while markets are going this way. And that's only consistent with a V-shaped recovery. If the V-shaped recovery does not occur and it's going to be a U, eventually markets have to flatten out and or correct the valuation that are justified by weaker economic growth. And therefore, down the line, not anytime soon, I see the risk of a correction, especially when the market is going to realize that the recovery is not rapid and V-shaped, but more like U-shaped. That might be a fourth quarter or first quarter of next year problem. Of course, liquidity can chase assets for a while longer, but the more you have this asset bubble, the more there is a risk of a greater correction down the line.
Down the line, what are we looking at? 10, 20% correction in the first quarter of 2010?
Well, I don't want to make prediction of that sort specific about exactly the timing, but I would say between the current levels and the lows of March, then a correction is possible. Of course, it's going to depend on how the recovery is going to be. It depends on how much this easy money can still push asset prices higher. It's going to depend on market dynamics and market sentiment and risk aversion. But I see a growing gap between what financial markets are doing and what the weaker real economic activity is in the markets.
If we need to tackle global imbalances, do we need to start with the currencies?
The currency adjustment is only part of the adjustment. You need a trade-weighted weakening of the US dollar, not as much relative to euro and yen, because that's going to crimp their own ability to grow again, but against China, against Asia, against commodity exporters. The constraint to that currency adjustment is that right now China has decided to go back to an effective peg by intervening and preventing any further appreciation of the RMB. Even when that change in relative prices occurs, to have a sustained economic growth, then the surplus countries will have to essentially start to save less and consume more domestically at the time where the deficit countries like the US are cutting back on their own domestic consumption, because otherwise you'll have a shrinkage of global imbalances but in an equilibrium with weaker growth if the overspending countries spend less and the oversaving countries do not compensate for the fall in spending by the overspender by increasing their own domestic demand. You could be a world in which there is a glut of capacity and global aggregate demand is weaker. So there is a disorderly way of reducing the global imbalances that leads to low growth. We want to do it in a world in which actually there is more sustained growth that requires changes in relative prices, but it requires also that the over-saving countries, the Chinas, Germany, Japans of the world, have changes that lead them to save less and consume more. I don't think that's likely to happen anytime soon. That's why I worry about demand lagging behind supply and that leading to a slower recovery of the global economy.
But how essential is it that the Chinese actually let the yuan appreciate and appreciate it pretty quickly?
It's part of the adjustment. If that appreciation were to occur, then imports become cheaper and they would import more. But that's to do other reasons. The reason why the Chinese save a lot is also because they don't have a social safety net, they don't have social security, they don't have good public health care or public education, and they have to need to save for all these reasons. Therefore, China has to do the kind of reforms they're going to create that social safety net. It's going to take many years before consumption growth is going to be higher and the savings rate is going to fall. In my view, that's going to take many years, however.
Are you confident that the US government isn't really supporting a policy of keeping the dollar quite low?
Well, officially the US government speaks about liking a strong dollar, but the reality is that if consumption growth is going to be below GDP growth, with consumption being 70% of GDP, GDP growth is going to be very weak, and therefore you need other components of demand to boost growth. It's not going to be government spending because the fiscal stimulus is going to run out of steam. It's not going to be capital spending by the corporate sector because we have a glut of capacity. Utilization is only 70%. It's not going to be residential investment because has fallen and is going to grow only weakly. So the only other source of demand may come from net exports. That requires two things: a weaker dollar on a trade-weighted basis and a faster growth rate of the rest of the world.
The IMF this week increased their growth forecast for the world to 3.1% next year. Is this achievable?
Well, it is achievable, but it's still anemic growth because anything below 2.5% for the global economy is technically a global recession because the growth rate potential and actual of emerging markets is so much larger than the one of the advanced economies. So 3.1% actually is a very weak recovery in which in the advanced economies growth is well below potential, and even in emerging market economy their growth rate is going to be accelerating but not reaching the very robust rate that was achieved in the Goldilocks years between 2004 and 2007. So it's an anemic global economic recovery that the IMF is forecasting right now.